Stolen identity refund fraud, or SIRF, is exactly what it sounds like. A thief steals a real person's identifying info, files a fake tax return fast, and tries to grab the refund before the legitimate taxpayer files. On the EA exam, watch the timing angle. The fraudster wins by filing early and looking normal enough to pass basic filters. Mechanically, SIRF usually follows the same playbook. The criminal gets an SSN and name, invents wages and withholding, and routes the refund to a bank account or prepaid card. The return can look believable because it's built around common credits and a refund due. Exam tip: the IRS is fighting refund fraud, not just identity theft in general. The scale is huge, and the IRS loves testing attempted versus paid. In one IRS report, about $30 billion of identity theft refund fraud was attempted in a tax year, and about $5.8 billion was actually paid out. And that paid number can still be understated because some fraud slips through undetected. One of the IRS's best defenses is the IP PIN. That's an identity protection personal identification number. It's a 6-digit number that helps the IRS confirm you're the real filer. Key exam detail: an IP PIN is only valid for a single year, so you don't set it and forget it. You use the current year's IP PIN when you file. The IRS provides the IP PIN on a CP01N notice. Here's the filing nuance they like to test. If spouses both have IP PINs, only the person whose SSN appears first on the return needs to input their IP PIN. That's counterintuitive, so it's a classic exam trap. Also remember, the IP PIN is tied to identity verification, not to payment methods. What if the taxpayer loses the IP PIN? If they decide to file a paper return without it, expect delays. The IRS will likely pause processing to validate identity before issuing a refund. That's the whole point: slow down suspicious filings. On the EA exam, the right answer often includes processing delay or identity verification when the IP PIN is missing. Marisol is a tax preparer. She has 3 clients who all share the same bank account: 2 elderly parents and their adult son who has check signing authority. They'll file separate returns, but each wants direct deposit of their refund into that one bank account. Is this permitted? The choices include not allowed at all, allowed for just the parents, allowed because there's a 3 refund limit, or everyone must use separate accounts. Think about it. The correct answer is yes, it's permitted, because a single financial account is limited to 3 electronically deposited refunds per tax year. Here, there are exactly 3 refunds going to the same account, so it fits the limit. The tempting wrong answer is no, only 1 refund per account. But that's not the IRS rule. 3 is the key number. What is Internal Revenue Code Section 7216, and why is it relevant to tax return preparers? The options include a criminal rule on disclosing or using return information, a civil due diligence penalty for EITC, a civil fraud penalty, or a criminal fraud penalty. Think about what 7216 is really targeting. The correct answer is that IRC Section 7216 is a criminal provision that prohibits tax return preparers from knowingly or recklessly disclosing or using tax return information. It's directly tied to preparer confidentiality and permitted uses of return data. A tempting wrong choice is the EITC due diligence penalty, but that's a different set of rules entirely.